Good morning, traders. This is Chris Buss with Traders Profit Compass. It is early Friday morning, February 25th. As I'm starting the video, what I wanted to do is run through the Spyder ETFs to give you some perspective on the big rally that we had yesterday and as we head towards the end of the week. Don't forget to run the video at 1.25 to 1.5x. I think you'll enjoy that speed. And of course, you can pause the video at any time to make a note of some levels or take a note. What I wanted to do before I get into the price charts is to take a look at the high-low index of both the Nasdaq and the NYSE Composite. I think it'll give you a real clear picture of kind of where we're at and the various regimes that we've been in over the last couple of years. So here we have the Nasdaq High Low. It's very, very simple. You take the number of new highs and you subtract the number of new lows and you get a number. And then you graph that. And then what I have here is just a line across at the zero line, a line of demarcation, if you will. And so this particular chart, I mean, I could go back years and years and years, but I think for the purposes of this video, just go back a couple of years, pre-COVID, COVID, and then the period after that. So heading into COVID, you can see new highs are comfortably exceeding new lows. We had the COVID snap recession where everything fell apart, and then we had the recovery, and then since then we have been comfortably above with periodic dips below. And if you were to kind of overlay this chart on top of the Nasdaq chart, you will see that these dips more or less coincide with the 50 EMA. And you know, over the last couple of years, that's by the dip. The 50 has done a great job over that period of time of keeping the bull trend, with a few exceptions, but by and large, that is where people have stepped in and successfully bought the dip. And then, as you can see here, in late November, actually after Thanksgiving, something changed. And you can see something changed just by looking at the chart. You don't have to necessarily know what changed, but you can easily tell on this chart that there's been a change. Now, you can see that we've had no net new highs above the zero line since that period of time. Every time it comes up to the zero line, those rallies are sold. And it might interest you to note that yesterday, despite that historic rally, we actually dropped. There were way more net new lows than there were new highs yesterday. And you can see this was the low down here in that January low that everybody's been talking about, watching the January low. We're not down to that level. We did have that snapback rally that brought it up, but now we're proceeding down again. So that's cautionary, because you can see that we are, most definitely in a different regime. Let's look at the New York, exactly the same index, new highs minus new lows. I have this chart a little bit more developed with some different levels, but I think I can get the point across. This goes back into 2017. And at the end of 2018, you'll remember Jay Powell in that September timeframe, uttered the famous words, "We're on autopilot," of 25 basis point rate increases, and then the whole market locked up, credit locked up, there were no loans. The market went down, 20-25% in a straight line, culminating in that Christmas low, that Christmas Eve low, if you'll recall. And then on January 4th, after that dead holiday, the interim period between Christmas and New Year's, on January 4th, coming out of that holiday, he did the Powell pivot. And then we pop right back up and working, within this range, generally bullish. And then we had the COVID crash, the recovery, and then right back up into the bullish regime where the dips were all bought right along the way. And again, you could overlay this chart on the Dow or the NYSE chart, and you'll find that those generally coincide with the 50 until something changed. And that change was this year. And now we can't seem to get above the zero line. And I've got a little thing here above 100 is kind of escape velocity up this way. And then below 90 is problematic. And we're at minus 770. Again, on this chart, there were many more new lows yesterday than there were new highs. So just from these two measures, and you can see that we're clearly in a different regime. And if you've been with me a while, we've been talking about the draining liquidity pool that's going to be coming up as the Fed gets out of the bond buying program and starts to tighten rates. So let's go through the Spyder ETFs. I'm not going to go through all of them, but I'm going to go through the most important ones to kind of see where we're at. XLK Technology, 44% Apple and Microsoft, and that's something you may want to take a note of if you want to kind of participate in Apple or Microsoft, but not have the specific stock risk, or you rather just trade a technology basket. The XLK is going to be good for that. Let's look at the RSI regime. Anything under 50 kind of is the bull bear zones. We're clearly pinned under 50 with a declining RSI trend. We've dropped out of the bullish regime on momentum, PPO. Now we're in the bearish regime with a fresh PPO bear cross. We came down off the highs. We made the January low. We had the kickback rally into this EMA structure and the downtrend line. And then we rolled over. We made a big run at 142, took out the January low, and then had the historic rise. What I want you to take note of is that rise, as dramatic as it was, just brought price up to the declining 8-day. So price remains below not only all the moving averages, but also below the 200. So going forward, what you can do is simply set yourself an alarm at 155 as a level that when and if you get that trigger, that'll bring you back to the charts to say, you know, price is back up above the 200. All things being equal, that's a bullish technical event. And then what you'd have left to do, or what price would have left to do, is break out of this downtrend line and give itself room to run. What you can do is go through these different levels. If you want to set downside alarms or fine-tune your charts, you can mark this high volume over price node here at about 150, 150. You know, if we were to drop back down below that, or you can even go down here to 147 and mark that as dropping back below the January spike low. Let's look at the weekly chart really quick. Nice uptrend. We topped out. We dropped out of the channel, and now we're still below the 40-week moving average, which is, generally speaking, the demarcation line between a rising bullish stock and one that is starting to lose touch. So what makes today important technically is this week's candle won't be finalized, of course, until the end of trading today. So if they're able to recover the 40-week, that would be very bullish. If they sell it down, on the weekly chart at least, there'll be no technical changes. It'll still be in a bearish posture. And you can see here that on the RSI, we've dropped below the 50 line. Moving on to XLV, bearish regime RSI, bearish regime momentum, but with a little bullish divergence here. Actually, on both of them, bullish divergence. We made a fresh low, but that was at higher momentum and higher RSI. So there's your bullish divergence. That said, still well below all the moving averages and below the 200. We've got a level here for the 200 at 128.50. That would be an area to alarm. I would certainly alarm 124 at the opening low yesterday, well below the downtrend line. Moving on to financials. Consolidating in a range between 37 and 40.5. We had a couple of false breakouts that resulted in moving back to the bottom of the range. Remember what we say, when you break out, you never want to go back in. Here's another example. Broke out, bull trap, down to the bottom of the range. Breakout, bull trap, down to the bottom of the range. That's why it's important to have those levels in mind, because when they fail, that usually is the scenario that plays out. You can see here that price is wrestling with the 200, just above it now. I would certainly have yourself an alarm at 37 at the lows. If it drops out of this box, we've got a $3.50 trading range. $3.50 from 37 is going to put you down towards, let's see, 33.5. 3.5 from 37 is 34 or 33.5. So that would be a technical target down here should we drop below. So I would certainly have that level marked. we've got a little gap to fill. Just notice we've got declining momentum and we've got declining RSI. So just in consolidation mode right now, nothing dramatic to worry about. Moving on to industrials, they got killed yesterday. I don't know if you saw Caterpillar and some of those names, 3M, Honeywell, really had a rough day of it. So again, declining RSI, bearish regime, declining momentum, bearish regime, fresh bearish momentum cross here. We've had a big trading range between, let's just call it 105 and 97.5. We took a big drop below, found that support at 94 at yesterday's open, and put in the big rally. But you can see here that price, number one, is still below the trading range. Number two, it's not even back up to the declining EMA, the 8 EMA here at 98, and well below the 200 here. So this one is, it looks like a big topping pattern to me, where price has dropped out and now has a lot of work to do to come to recapture the trading range and then wrestle with these overhead moving averages that will be resistance. And then, of course, you've got the declining trend line as well. Notice here another double top type structure. We saw that on Amazon. We just looked at it on the financials. Quite a few stocks. Netflix had that kind of a look. So just interesting to note. Communications. Basically what we're charting is Facebook and Google. So is 44% of this index. You can see in RSI, long bullish regime up until October of last year. Then we dropped down into the bearish regime here below 50. Same thing on momentum, long period of time holding above the zero line. Then we dropped below and now actually making new lows in momentum. Here in this case, we've got a full bearish stack on the EMAs. What do I mean by that? 50 below the 200, 20 below the 50, 8 below the 20. We took a big dip down to 64 before the sharp kickback rally. Now we've got a line of resistance here at 69.5, 70. I would certainly put an alarm there on your charts. I would also put an alarm at 64 at the low of yesterday. And then this may be something here at 69.5, 70 that you want to, if it can recapture that level, all things being equal, that's a bullish technical event. Remember, recapturing a level from below is bullish, and you might get a run up towards the 50 or up to this 74 level, even potentially 76 here at the strong downtrend line. Consumer discretionary, bearish regime, falling RSI, falling momentum, bearish regime, bear cross, nice uptrend line. We broke that, put in a bear flag here, broke out of the bear flag, and made a quick drop down to 162. Then made a nice recovery back yesterday above 170. But again, notice below the 8-day, below the 20-day, below the 200, below the 50. I haven't drawn in the downtrend line, but you can easily do that on your own charts. Off the high, pick off this level here, continue it down. So a lot of work for this to do just to get back up to downtrend resistance. Moving on to staples quickly. Different kind of a look here because staples are more or less a defensive sector, and they have held up a lot better than more of the offensive sectors. So we've got a nice uptrend, coming off 2021 lows, few touches here of the 200, got close. We touched the 200 again yesterday, got the big bounce. You see we've got a level here at 74.25 at these lows, and we've got a series of lower highs off the top. Bearish regime here, and still more or less bullish, but making a move lower on momentum. So if you're interested in these, or if you have fled to safety, the Procter & Gamble's, the Kellogg's, the Walmart's, the just all those names, the food names, the various retailers, grocery retailers, drug retailers, CVS, Walgreens, all that kind of stuff is in the consumer staple sector. If you have fled to safety, what you can do is just set some alarms where you can get a heads up on when that's no longer working. And I would certainly have an alarm at the 200 if you had a basket of those names in your holdings for the dividends or whatever. Materials is not a big part of, I think it's only a few percent of the broader indexes, but I wanted to go through them to show you that the bearish regime has taken over here, lower RSI, lower down here below the 50. Same thing in momentum, falling momentum, bearish regime in momentum, fresh bear cross, came down off the highs, put in a nice bear flag, dropped out of that bear flag. Now we're below all the moving averages, put in the nice rally off of 80 and more or less closed the gap. But like all the other ones, a lot of work to do with price still below a downtrend line and all the averages. I would certainly set an alarm at 82. I would certainly set an alarm at 80, simply to give you a heads up that this recovery is proceeding, or it's failing. And I would also alarm the 200 here at 83.20. That would be a bullish technical event. There's really only one chart that I looked at that looks truly bullish, and that's energy. Consolidation range, breakout, consolidation range, breakout, consolidation range. Now, it had a bad day yesterday, but in general, this is stair-stepping its way higher. And what I would do is identify this range on your chart, marking the high of the range, 70, and the low of the range, 67, which aligns well here with the 20. And then what you can do is either take a position here at 67 with, a stop just below. I mean, you are at support of this flag, So you could give that a try, even if it's just for a move back up to 70. That would be a winning trade. Or you can wait for a breakout above 70. I didn't write it down here, but you should be aware. Basically, what you're charting here is ExxonMobil and Chevron. I believe they're 40% of the index. So what I like to do is use the XLE as a flag. So for instance, if we got a breakout here, just use that as a heads up to go start digging into energy or whatever sector it happens to be. If you want to go down to the stock level, keeping track of the SPDRs is a great way, so you don't have to set 80 alarms. You just go through your sector ETFs, set some alarms there that will give you heads up to go start digging into the specific sectors if you want to get more granularity on your picks. So here's the point I want to make. Don't get into the mindset that, quote, yesterday's low was, quote, the bottom. It may prove to be, but at this point, the jury is still out. Those high-low readings should clearly show you that we have not yet broken out of those bearish regimes, constantly printing more new lows than new highs. Of course, as a chartist, I can go find bullish charts and I could flip the whole thing the other way, but that's not really the point of what you want to stay neutral, not really having a horse in the race. We all see what we want to see, and we'd all like to believe that was the low, but I really think there's more downside to come, at least a lot of choppy trading, which is what we've been talking about. And I think you should view your longs as rentals. I mean, we're all traders. Trade the rally as long as it's there, but keep in mind the bigger picture. As long as you're below the 200 and the 40-week moving average, that puts the chart on a bearish tilt, and that is why I say view the longs as rentals. You can have a bear market rally of significance, of violence, as shorts cover. And if you look at yesterday, what did the best? It was all the junk. It's all the stuff that got really beaten up. I was in ARK. I had to cover that. Big rally. Squares and PayPals and, Roku's and, all those names rocketed higher. And a lot of that is short covering. So don't be fooled into thinking that, now you can, buy Roku or whatever name, Zoom, and, tuck it away for a long time as a long. I think it's going to be, there may be more to the rally today and in the next week and the week after. That's fine. But until we break back above the 40-week and the 200-day exponential moving averages, either on individual stocks or sectors as a whole, and we start seeing some new highs print on the charts that I showed you, I think you've got to be very tactical about your trading and make sure that you don't get on the wrong side of the market with a bunch of names. So I'll leave it at that. I hope you got a lot out of the video. If you're new here, thank you so much for spending some time with me. Spend a lot of effort giving you levels to trade against that are objective and correct. If you appreciate that kind of analysis, please hit the subscribe button and the alarm bell. That way you'll get my YouTube content, and you'll also find a place in the show notes where you can join the team with just your email, and that way you'll get my content morning, noon, or night, midday market notes, trade ideas, weekend notes, etc. right in your inbox, and you'll also get an invite to our trading room. I really like the community we've built there, and we'd love to have you be a part of it. So let's wrap it up there. This has been Chris Buss with Traders Profit Compass. Have a good day of trading and a nice weekend. Talk to you next time.